works. All right, so we started recording for today. I'll just give a little bit about, the statement I made about the Mexican oil hedging program. I made a statement about the sophistication of the hedging program. So let's start with that. We'll just talk about it a little bit. I just wanted to make sure that the point is properly understood, because this is very important. It's not a technical point, really, almost not a technical point, but it's very important to understand, especially in our country. Many people don't understand it. So why am I saying that? We had a discussion yesterday about the Mexican oil hedging program, and Siddhartha sent a link as well, which I'll share with you guys. That it's got some pretty good information actually on it's an IMF link, so it's quite useful. Now, why did I make the statement yesterday that the Mexicans are very sophisticated hedgers? As I told you, what we heard from the market information, this kind of program, you only hear there's market chatter, so there's some kind of news item and things like this is how you hear about it. So I remember hearing about this around this time when the price was around, so they usually search around, I think, in the market around the end of the year. So if we look at this, so this is where we're going to zoom into. If you look at historically quite low levels, that is one of the reasons that I was talking about. So I was pretty animated the other day talking about it, but let's talk about this. Yeah, so this is where we were based around here. I remember it was around 35, pretty low, okay? So 35 around this time, yeah. So it was around the end of the year, towards the end of the year, the beginning of the year, when they come into the market, start looking around. So now what I was saying is that they were looking at price, they were hedging, they're executing their normal hedging program, even where prices are at $35, which is pretty low, historically speaking. Okay? Pretty low levels historically, that is what I was saying, that as an oil producing country, to be hedging at these kinds of levels it must hurt a lot, because it's almost near all-time lows, although you know that it's not really all-time lows. We did have prices for many years stuck around $10, $12, so this is around $12. So it could have gone a little bit lower as well. So the reason I said that they were sophisticated hedgers is that they have a very good understanding. Okay, so let me just write this. Okay, we should write it, and I'm just writing it. I'm not writing perfect English. I think I've told you guys that as per is in Indian English, okay? You don't write as per. If you read English written by Westerners, you'll find that they don't write as per, they always write per, okay? Per, because per means according to. So hedge production per usual pattern, okay? In December 2015, even though prices at $35 near historic lows, okay? They will write it as had, okay? This is an important, it shows a very sophisticated understanding of the markets and what can happen in the markets. So even though prices were at $35, which is historically at very low levels, but they have the wisdom to understand that prices could go even lower and stay depressed for many years. And if you think that can't happen, as we say, circle back to this. I was actually working in the Middle East at that time for some of this period. If you look at it, look at this period from 83 onwards, it doesn't really go above till about 2003, okay? So it's almost a 20-year period where you look at the range of the price, it's around $35 to about $12, okay? It was actually even 11, I remember seeing in Bahrain, $11 crude oil. Okay, and it was really bad for the Middle Eastern countries because they're all long oil. So you've had this period where it could go like here. So that's why I'm saying that these guys are very sophisticated, even though this kind of high levels had been seen and so much volatility had been seen. They're actually hedging their production as a long oil, natural underlying position being long. They're hedging their production even here, according to their normal pattern, because they understand that price, even though it's here, it could actually even go lower than this and then stay depressed at low levels for a long period of time. And therefore, if that happened, then their decision to hedge at $35 would look very good. So the reason you hedge is you basically lock in whatever you can, whatever realistic levels you have, whatever realistic levels the market is giving you, just take it and try to get some certainty to your cash flows. So this is a very sophisticated approach to the financial understanding of financial markets and a sophisticated approach to hedging, which I can guarantee you in our government, the bureaucrats and people who run these kind of decisions, no way they would be taking these decisions. And as I told you, they actually did the opposite kind of thing in the case of the Qatari gas purchase program. So this is what I meant by, I just wanted to make sure that people understand what I said, what I meant when I said the very sophisticated hedges, because it's an important point to understand. It shows their wisdom about the markets and to understand what financial markets can do to you. They can completely destroy you. And if you look at this also, nobody would have said that prices would go like this, 147.47, I remember, on the front month contract when these highs were being hit. And as the prices shot up like this, if you look at the way those prices went up, and as they were going up, there were many airlines, many regional airlines. I remember at least 3 airlines, names I don't remember now. At least 3 regional airlines went bankrupt in the last few months because they just could not handle, nobody had budgeted for this kind of oil price. That oil prices would be at 125, 135, 145. Nobody had budgeted for these things, and obviously you can't change your ticket prices. If you want to stay competitive, you can't change your ticket prices. And if the cost of gasoline, cost of jet fuel is going up like this, then you're dead. And that's what happened. We saw many small regional airlines going bankrupt because of this kind of dramatic rise in the oil price. So if they had some reasonable hedges in place, this would not have happened. But anyway, so this is what I'm trying to say. On both the upside and the downside, you have to have a sense that anything can happen in the markets. So this is an important point to drive home, because it's not something that you hear about. And most people will not tell you these kinds of things. In fact, most people will say, as I said, our chief economic advisor around the same time when these things were happening, chief economic advisor said that oil prices won't go above $45, around 35 that time. Well, pretty soon it was back up to 75 or something. So, so those kind of statements do not reflect a good understanding of the market. So maybe I'm repeating myself here, but it's important to understand and drive home this point, okay? All right, okay, so India's FX risk hedging. So Ketan sent me an article the other day about the Indian oil. So the description that I gave, the description of the story that the kind of a case study that we discussed briefly of India borrowing money from the Swiss francs from the IMF. It's the same kind of situation that was being described in that article that Ketan sent. I think it came out around last year's budget, when there was an announcement that the government of India will be borrowing. I haven't followed what they did this year, what she said this year, but she introduced this idea for the first time last year, Nirmala Sitharaman, that the government of India would be borrowing in foreign currency, in which case the risk management would be exactly like I discussed with you yesterday. So that discussion was appropriate in terms of what may actually happen in the case of the government of India, right? So that would be the same kind of, the hedging framework would be the same. So, Ketan, can you tell me if you could just let me know if you can locate the date of that article that you sent me, then just send it to me, okay?
Okay, sir.
Yeah. So anyway, so this is basically where we are. We were covering this point, the dynamic versus static hedging programs, and I think everybody understands now. Yeah. So the unwinding actions to unwind and reinstate the hedge positions will be motivated by the views of the hedging team. So let me just highlight that. And that's why I said that is once again a reminder of why you are made to do these kinds of trading and risk management projects. Because in the real world, whatever you do, pretty much every kind of decision you take as a finance professional, especially if you're an MBA, like there are a lot of finance jobs which are given to accountants and lawyers, like compliance, accounting jobs. Those kinds of jobs don't require market views, but I'm not talking about them because you guys are not accountants and lawyers, you're MBAs. So MBAs, when they do finance jobs, pretty much every job is going to involve some kind of taking a view, view taking on the markets. And therefore, there is no guarantee about what would happen. You might take a view and you end up being wrong, and you might end up being wrong. And that's just life, and you'll have to deal with it and manage your situation. Try to manage the damage from your mistake. Okay, and this is how you'll have to manage. And there's never going to be a clear-cut answer. So it's a bit like life itself. You don't know what's going to happen, but it doesn't mean that you just sort of give up and just surrender. You still go through life. Strange things happen, and then you deal with it. Some of the outcomes are not very good, but you find a way to deal with it. This is how you'll have to manage even as a finance manager, because everything is uncertain. And so this is another point to understand. Right? This is all the actions of hedging and unhedging, unwinding and reinstating the hedge position will be based on the views of the hedging team, right? To reinforce the idea that taking views on, that's why, the point of all these kinds of courses is to get you comfortable with this idea of looking at markets and taking views on financial markets. Which way is oil going? Which way is dollar yen going? Which way is the S&P going? You got to get used to this stuff. It should be just like, brushing your teeth. That, okay, I get in there and I look at the charts, I follow the news, I look at the fundamentals, and I take a view. And that view could be wrong. And if it's wrong, I take some adjusting decisions to manage to keep myself alive. All right. So, as I said here, obviously there will be an impact on the unwindings and reinstatements of the hedge position will have impact on realized losses and profits on the hedge account. Okay. Now, this statement is true, actually. So let me qualify that. Since many, instead of saying would is very certain, it's a very certain kind of statement. May well, that was a little bit better, because not all hedging programs, but many hedging programs are so this statement is true only when you have futures contracts. in many cases of forward contracts, you may not actually have to show the loss, depending on which jurisdiction you are in. So therefore, this is basically the statement. That's why I changed it. Your realized losses and profits will occur on the hedge account P&L, which is going to happen in your project as well, because your project is going to, basically, this is an example of your project is an example of this kind of situation. Your project is an example of where hedging programs are going to use futures contracts to hedge positions. Okay, your project is an example of that. So you will, as you do it, you will find you have losses and profits that are being realized on a daily basis on your hedge account. So okay, so this is the and there is the element of the, you know, how much of a loss can you take on the hedge account, because it's not I mean, the market is moving in a way that the hedge positions are losing money, even though you put on the hedge pretty much 100% hedged, but then you're realizing losses. And then how long can you handle that? So those kinds of considerations will have to be considered. All right. So let's go back to, so this is what we were looking at. So we spend a little bit of time on the decision, on the types of hedging programs. And we go back to here, where are we? Let me just see if we have anything. We just go back to this a little bit. So the other decision problems that we have, this, of course, BP5, this is basically what you're going to be doing all your throughout your project, which is not much of it is left actually, because there's so little time. And exit price, okay, these are all based on your views. And here, in the case of exit price is split in two, because we are discussing a static program, okay? So I just want to explain how these decision problems are working out in the case of managing a passive risk book, going back to this topic, okay? And you notice, so exit price is 6, we are not discussing directly because 6 is being split into 6.1 and 6.2. So if you have an exit price with loss and exit price with profit, okay? If you're doing a static hedging program, neither of these will be actively solved because these are all automatic. As I said, you put on the hedge and then you will only take off. There's a question of exit only arises whether you have a loss or a profit. The question of a hedge in the case of a static hedging program. So I'm not giving this particular diagram that we have, okay? This particular diagram, or whatever you want to call it, a table or something like that. It looks like a table. This kind of table is made only for, that's why there's this comment there, that here we are assuming that there's a static hedging program. Because if it's a dynamic hedging program, we would have slightly different answers here because these are all going to be active, okay? So we're not discussing that. These are obviously going to be active because you will take a view on, if you put on a hedge and you're losing money, you'll take a view as to at what point you want to get out of the hedge and go back to being open on the position again. And as far as take profit, in the case of, basically in the case of, let me see how many, okay, this is a double star. Let me just put this clarification here so that you don't get confused, okay? So let me put a 3-star. Now this should not be a 3-star. So let me put this as a 3-star because that is coming before this, okay? So exit price 6.1, all right? 6.1 here, let me put a double star. And let me put a triple star here because this entry is coming after this entry. So I'm going to put 2 double stars here. And I'm going to put this note over here with a double star on top of this. And then what I'm going to say is that I'm just clarifying here that if we are going to be running a dynamic hedging program, So just to clarify to you, okay, but we are discussing this table is drawn. This table is drawn with the assumption that it's a static hedging program. So I'll just quickly explain this why this is automatic, because we already discussed it. But as I said, in the static hedging program, you do not do anything to the hedge until the requirement for the hedge itself goes off. So just once again to repeat this, if you go to let me bring that from here. Just give me a second. So we yeah, why are we saying that in the case of a static hedging program, it is let me just open that spreadsheet. Yeah, why are we saying that? Because what we are saying is yeah, so if you put on a hedge, so if you have your underlying position is long gold, you go short by selling 25 futures contracts. You want to hedge the full position, and so you go short, and then your total position goes square. And as we have already discussed several times, but I'll just quickly wrap it up here and show you that. Right. So you start with, we can actually, we'll just remove this. Position is 0. Right. So you start with, so the underlying position is maybe, let's say, whatever. Some, in this case, it's minus 2,500. Okay. It's actually underlying position is long 25. Okay, so we'll go back to the earlier gold example. That was an oil example that we were talking about when Srishti asked about the MG refining case. So I changed the numbers a little bit on the first row. So we go back to the oil, the gold example. So the reason we say that this is why are we saying this? In the case of the static hedging program, the decision problem 6.1, which is exit with a loss, and decision point 6.2, decision problem 6.2, exit with a profit on the hedge with respect to the hedge. These loss and profit are with respect to the hedge position. That's what you're managing. Yes, anybody has a question? Okay, so the decision, the answers are all automatic. Are they automatically solved, or do you have to actively solve them? Why are they automatic? Because the way you're supposed to manage in a static hedging program is you have this position, you see 25 contracts long in the gold case. In the case of gold, your underlying position is long 25 contracts, equivalent of 25 futures contracts. So we write it as 25 long. And then you have, initially you have 0 hedge, okay, on that. And then you go short 100%. So you go short 100% and hedge 100% of the position. So the total position goes to 0. And then eventually, when then you may we don't write it as unwind. We write it as like this, okay. And then when the underlying position goes to 0, what does that mean? That means that you come to know from the sales team that this consignment of 2,500 troy ounces has been sold to Tanishq. So therefore, it may still be lying in their mind, okay, but the shipment is a different matter, but the contractual sale has already occurred. So therefore, for your purposes, economic exposure balance sheet, although on the accounting balance sheet it will show because the inventory is still lying in the mine. So it will show on the accounting balance sheet, but on the economic exposure balance sheet, which is what you're supposed to be managing as a hedging team manager, On that, this will no longer exist because there is no more there isn't any more price risk on this amount of 25 contracts. All right. So what you do, therefore, is now you're faced with a situation like this when the underlying position has gone to zero, and you're still holding your short hedge position. Now you've gone to your total position is minus 25, which violates this rule that if it's a long underlying position, then the total position must remain between zero and the initial amount of the underlying position. So this rule is violated. You can't have this. There is no justification for this hedge position. So you would unwind this hedge position. You have a short hedge. So you would go into the futures markets and you would buy 25 contracts and close out the hedge position, and that would go to zero. So then you would have zero underlying, zero hedge, and total position goes to zero. This is your ending position. That's why we are saying, so when you actually close out this thing, has nothing to do with your market view. When you close out your underlying position, your hedge position and go to zero, has nothing to do with your market view, and it has everything to do with when that underlying position is no longer represents an economic exposure for your company. Your sales team tells you that that particular consignment has been sold. So that's why we say that these are automatically solved, because we are discussing a static hedging program. You're not supposed to lift the hedge until the exposure has actually run off. So this also further cements your understanding of the types of hedging programs. And the same applies also to take profit, because it is completely irrelevant as to whether the after you put on this hedge, okay, go short 25 to cover the long underlying position of 25. It is completely irrelevant. Well, not completely irrelevant, because there are cash flow consequences. As I said, if you have a situation of 25 contracts is not very big, but if you have a large position, and if you have, if we go and write gold, so as we said, this is a CFD contract, but it is plotting the C. Now you can see long-term gold price. So this price used to be, this is the international market for gold, very liquid and active, highly speculative market, and active pretty much 24 into 5, along with the foreign exchange market. So this is a market for spot gold. Spot gold, US dollars per troy ounce. Very active market. Okay, now if you see, this is 1984. In 1980s, it shot up. In the 1970s, the early 1971, this price, which is today around this level, okay, it went above 2000. All right. Yeah, 1840 now, but it went over 2000. This price used to be, just for your own perspective, because we have to deal with economic history as well. You should be familiar with economic history. In 1971, this was $35. Okay, this stuff that is today trading at 1841 went over 2,000 recently. This stuff was, imagine that, 1 troy ounce of gold used to be worth $35 US in 1971. This is when the modern currency regime started, when the US, at that time, the price of gold was fixed against US dollars. So everybody could buy and sell gold at $35. And then the US decided, President Nixon decided to get rid of that system. So he said, no, we are not doing this anymore. And so people were basically giving them gold and taking away US dollars. And he says that we are not going to put up with this anymore. So he stopped the system. And that's when we have the new system of currencies, floating currencies, and this dramatic movements in the gold price. So anyway, so just for your perception, just for your a little bit of economic history, you should know these things. Now, if you have a short hedge on futures contracts, okay, remember that. So when I said it's not without it is not totally irrelevant. That's why I checked myself. It's not totally irrelevant. I said the stop loss and the take profit are the same situation, because it really does not matter whether you're making money or losing money. But that statement is not strictly true, because if you're losing money on the hedge, it will make a difference in terms of your cash flow because your underlying position is not going to be generating realized losses, realized profits. As the gold price goes up, your underlying position is long, but your hedge position is going to be generating realized losses. And that's going to be a problem at some point of time because you have to fund these losses in cash. So that's to check my statement that it doesn't matter. But from a principle point of view, from a policy point of view, it does not matter because whether your hedge is showing a loss or a profit, the rule remains the same in the case of a static hedging program that you are not allowed to lift. You're not allowed to lift. I think we have the hedging programs here. In the static hedging program, you are not allowed to reverse the hedge position unless the underlying position runs off. Okay. That's the principle that I was talking about, and that is the context in which I'm saying it makes no difference whether you're making losses or profits on the hedge position. But of course, that statement is not always true because it does make a difference from a cash flow point of view. If your hedge position is showing losses, you're going to be funding those losses in cash, and that is a real life problem that you have to deal with. Okay, so that's the discussion of this 6.1, 6.2. As far as position size is concerned, okay, you can see once again, we have put this on, yeah. So here we have put this, I've written this, so you can write this any way you want. Okay, so the question here, again, remember the question we're asking with this respect to this table is the question that appears in the case where one of the questions that the CEO has asked is question number 3, where he's talking about how the decision problems that we face in managing an investment fund, how are these decision problems, how is the solution to those decision problems going to change now that we are managing a passive risk book and not an active risk book like an investment fund? How are those decisions going to change a little bit? As we saw in some of the cases, the decision problems are automatically solved and some are not automatically solved. So he's wondering about this. So in the context of that, when we come in the context of this question, when we come to the question of position size, okay, I have written this as auto because I have assumed, that's why when I've said auto, I put 3 stars here and I've given a qualifying comment and said that, here you can see this, right? I hope everybody understands the meaning of the statement. So I've only written auto. This could be either auto or active. You can also write this as either auto / active, but I've just written it this way, that it is automatic because if I put a further rule on you that, if I'm the CEO, a CFO, or if I'm the corporate, if I represent the board, head of the board risk management committee, then and I put a further requirement on the hedging program saying that you're running the hedging team, that's fine, but whenever you decide to hedge, so you have flexibility. Pretty much the only decision you're going to be taking is this. This is pretty much the only discretion you have as the manager of the hedging team, because we are making you run a static hedging program, which means you can't do 6.1 and 6.2 based on your own views on the market. This is the only decision flexibility that you have, that that you have some exposures. But if you think that the gold price is going to fall, if you have an underlying long gold position and you think the gold price is going to, if you think you're actually the bearish on the gold price, and therefore so you'll be inclined to hedge, but you actually, whether you hedge right here as a market with the market price, or do you feel that no, this is before it drops, it's going to go to 2000 and then drop, so therefore you decide not to hedge, you wait and try to hedge when it goes to 2000, or you decide that I'm not really sure what's going to happen, but I will definitely hedge. I'll sell my hedge futures contracts in the hedge portfolio if the price goes below 1762. Now these are all decisions. So here, if you hedged immediately, you'll be using a market order. If you use this way, you would be using a stop order, sell stop. And here, if you use this view that it's going to 2000, I'm going to hedge it there. And that would be a sell limit order. Okay, so this is the kind of, so if I'm a corporate board risk management committee head talking to the head of the hedging team and saying, okay, these are your parameters, you're running a static risk management program, a static hedging program. So this is pretty much the only thing where you have some discretion. Depending on your market view, you can decide which kind of order to use and at what time to hedge, which is basically, that means the DP relating to the entry price. That you can solve actively, all right? And we, as a corporate risk management committee, the board risk management committee will also lock you down. In most cases, they will lock you down into this also. Need not always happen, but they may well lock you down on this. So which means they might say no options, no spot, only use futures. So you may or may not have flexibility on this also. So pretty much the only area where you have flexibility as a hedging team manager is exactly at what point to hedge, what is the entry price, to use market order, limit order, stop order. And even the position, if we put an additional rule saying that if the corporate risk management committee, the board risk management committee puts an additional rule that, okay, guys, if you can use your discretion and decide not always to enter through market orders, but you can use limit orders, stop orders, and hedge at a price which is better than the current market, etc., by using your discretion. But whenever you hedge, you've got to hedge the whole thing. All right. So if you're looking at a underlying position of 625k pounds, okay, then when you decide to hedge your copper exposure, you've got to hedge the whole 625k. I don't want to see you doing 425k and leaving the balance. No, you don't have that kind of discretion. This will all be decided by the board risk management committee. They will tell you all these rules. They should be actually talking about all these things and specifying all these things, and the hedging team will have to operate within those guidelines. Okay, so if we put an additional rule that whenever you decide to hedge, you have to hedge the 100%. You have to hedge 100% of the underlying position, right? So which you can't do is basically, if your underlying position is this, you can't do, okay, let's hedge only 15. Okay, and leave this you are not allowed to do, because the board says that this is not allowed. Okay, so that's why, if that is the case, then if we are operating under this kind of rule, then obviously the question of when it comes to running the hedging program and the other decision problem, the last decision problem that we're looking at, which is DP7, which is basically what will be the units of the position size that we are going to put on, right? Like here, should we sell 25 contracts? Should we sell 15 contracts or 18 contracts? If you have that flexibility, then it's a decision problem that you solve actively. Otherwise, if you don't have that flexibility, the board has not given you that flexibility, then it's automatically solved, because it is determined by the size of the underlying position. Just like your DP4, the DP4 is automatic because it is determined by the sign of the underlying position, that is plus or minus. Okay, so if the underlying position has a plus sign, then your answer here is sell, because your underlying position is long, so your hedge position has to be short. So, and if the underlying position has a minus sign, then the answer here is plus, because is buy, because the hedge position has to be offsetting the underlying position, right? So that's the thing. So that completes the list of your, as we go through this table and we consider each of the decision problems, which each of the decision problems, let's make this look a little better, and over here. All right, so as we do that, you can see all these decision problems being considered. We've gone through each one of them. Anybody, any questions at this stage? Yeah, okay. We don't have to maybe ask at this stage because you're always allowed to ask questions at any point of time. You should just feel free to interject at any point of time. Okay, so let's look at whether we want to go back to the case and look at the next one. The four, okay, so these actually 4.1, if we want to consider question numbers 4.1 and 4.2 and 4.3, these are talking about the use of swaps, okay? And this is also a swap question, and this is also a swap question. Okay, so let's see, before this requires us to cover swaps as a different type of instrument. So we've done spot, we've done futures, we've done options, we haven't done swaps. So it will require us to cover swaps. So let's have a look at, okay, do we have any other question? Okay, then we have a question on LIBOR, and then we have the question about the 3-month Euro-dollar futures. So we'll consider this along with the swaps related questions in the which are in 4.1, 2, and 3. So let's now, what we do is, before we come to addressing the question of swaps are, 1 minute. Let me just see if we can complete technical note. Let me just see if we can complete the technical note. What do we have here? We covered everything. I think we just had a little bit left. Okay. We've covered everything. Okay, hedge transaction, hedge position, basis risk, types of hedging programs, decision problems, project goal. Okay, we'll come to that. And okay, so let me quickly cover basis risk. Okay, this is because I just wanted to cover the topics as much in sequence as possible. And this is not so important. The number 14 is not so important for your project, but we'll then come quickly to the project goal. So let's cover this point and let's go to basis risk. We already had some discussion on this, all right? So this should be actually market okay, so we should write this as, let's write this as market instrument. We should evolve a shorthand for this, because otherwise we'll have to write this so many times. If we evolve a shorthand for this, which is M X, no, we should write it this way. With a mathematical sign, it'll look better. Market instrument combination in the same market instrument combination. So market instrument combination means, same market instrument combination means if I'm talking about dollar yen spot versus dollar yen options, those are two different entities as far as this is concerned, because I'm changing, the market is remaining the same, but I'm changing the instrument from spot to options. So that would be considered as different. It's not the same. Okay. So let's put a little abbreviation here. M is star I. And we're going to put let's put this market instrument combination. Yeah. Okay. So this is how we would describe it. Let's give it a name, capital C. Okay. So M star I. So we don't have to write this stuff every time. Okay. All right. So now, so far, if you notice, a lot of the hedging discussion might have been under the implicit assumption that the hedge transaction is being done in the same market instrument combination in which the underlying position exists. Okay, we've already deviated from that simplistic assumption because we just had a discussion about gold, where your underlying position is in spot gold. Yeah, there you see this $35 that I talked about. So they do have all this data. That's very good. It's how you should be looking at financial markets, major markets like the stuff that I put on this balance sheet, copper, oil, gold. These are extremely important international markets. And so here you can see what I was talking about. 1971, you'll see that the price is $35. This is basically reflecting the fixed $35 price. Okay, they haven't. Yeah, it should be showing as $35 because that was the fixed price agreed after the war, actually. Okay, Bretton Woods Agreement. That's 1945, and then they agreed that price. And that's why you see the line is static. And then if you look at currency charts, if you look at long term, like you look at a dollar Swiss franc long term chart, you will find that it's kind of the inverse of this. You'll find that the dollar Swiss franc chart is it just kind of collapses from here because the broad move in the US dollar since 1971 is lower. Okay, the broad move, if you look at the broad trends, and that is reflected in the gold price as well, because as the US dollar weakens, the gold price strengthens. The gold is, you can almost think, although we treat gold as a commodity, you can almost treat gold as a currency. In fact, many people treat it like that. And that's why if you see in India, we have so many tight controls on gold imports, because they know that it's used basically as a currency. So it's a way of getting around the convertibility restrictions on the Indian rupee. And of course, we also have a big gold market inside India. So the government wants to protect the pricing in that market. So they want to control the supply of gold coming in from the international markets. So anyway, so gold is like a currency. I went into that discussion just to make you understand. Okay, make sure everybody understands. So if you see this going up, the two assets in this market here are gold and US dollars. Okay, if you remember, we were having the discussion with Shaurya yesterday. Two assets here are gold and US dollars. And so obviously if this gold is the base asset, okay, in this market. So these 500, 250, 750, these are all US dollar numbers. And so as the chart is going up, it means that 1 troy ounce of gold, which is remaining fixed all the time, is now able to command a price of a higher and higher number of US dollars, which means gold is getting stronger, the dollar is getting weaker. So if you look at this, if you look at a dollar Swiss franc chart and compare it to the international gold price, you will see it's like you flip it upside down. It's an inverse of this. So that's just something to understand. But that is also showing the fact that the dollar is getting weaker, because the dollar Swiss franc is, let me try and see if we can, this is an important point, because we discovered that there are some problems with the concepts. So let me see if I can chart links and see. It's very interesting, and it's very interesting to look at these things. FX stop, if we can look at. We'll just have a look at it. Okay, it's although it's not really part of what we are discussing, but whenever I look at charts, I can't help myself, and I want to talk about all the historical movements that have happened. What is this? This is dollar yen, actually. Let's bring this in. You guys may not have, I may not have shown you this chart earlier. So you can see the same kind of thing in the dollar yen also. This is the dollar yen chart. Yeah, this is much better. And I'll just show you the dollar. So this is United States dollar. If we make this, you can see this dollar yen. See, this is 1971 when the dollar starts to collapse. Okay. We can't see this. But if you see, this is dollar 1971. And if we go here, obviously there are Swiss franc, is CHF, Swiss franc. Yeah. Now you see, this is what I was talking about, okay? That the picture on the gold price, this is 1971, okay? You can't see this. This is 1971. You see the movement in the broad, the swings in the gold, in the dollar Swiss franc. This is here, the dollar is the base currency, okay? So the reason I'm showing you dollar Swiss franc is the euro started in 1999, 2001, around that time. So there's no continuous chart on the euro. But the Swiss franc has been around for a long time, unchanged. So you look at the dollar Swiss franc chart, you see this drop from 1971. You see the broad movements down, up, down, up, down. And you compare it to the gold price, up, down, up, down, up. Same broad movements, okay? It's almost like I flipped the gold price around here, because here gold is the base asset. So this is showing a weakening of the dollar over this period. And here, dollar is the base asset. So it is showing a weakening of the dollar, because each unit of $1 US is able to command fewer and fewer Swiss francs. Okay, so this is where you are. I don't know where I've ended it. This is maybe, yeah, this should not have ended at 2015. This should have actually been 2020. And then you'll have a slightly more illustrative chart. Yeah, so you can see more of this movement, but it's quite, as you can see, not much movement compared to the historical dramatic. So you see how dramatically the dollar has fallen since the 1970s. So these are also important things to understand. These very long-term economic movements, these long-term trends. So this is how you should look at financial markets. Whenever you look at any particular currency, if you're studying the British pound, go to a chart like this, and then look at what is the historical. And then you ask yourself, why did these big moves occur? What was happening in the British economy at that time? What was happening to the US dollar? So it's very instructive. These are the kinds of things that you have to learn, because if you don't understand economic history, you are going to make the same mistakes that people have made historically, okay? Which is one of the reasons why I have asked you to study this chapter 37, if you remember. Here. Derivatives mishaps and what we can learn from them. Okay, these things are very important to be aware of what has happened in history. The very important part of your learning. Unfortunately, when most of the business schools now, because they're not really, the people teaching are not people who have come from industry. So they teach academic stuff, and they teach all kinds of fancy mathematical equations, which are really not of much use. And they don't teach much of this economic history, which is very important to understand why these things happened. Because these same things can repeat, in the future. So you've heard this expression, history repeats itself. So I would just use this opportunity here while discussing this. Not really what we wanted to discuss as part of our, we were trying to go to basis risk, but I can't help myself. When I start looking at long-term charts, I'm inclined to talk about history and stuff and comparisons. So I'm just getting into this discussion, but I think it's useful for you because it also helps to reinforce some of the concepts. What are the two assets of these markets? What is happening when you look at a chart going up? That means the base asset is getting stronger. The terms asset is getting weaker. These kinds of basic principles. You don't memorize them. We should understand why we have these why we can make these kinds of inferences. Okay, so a little bit of a detour there, a little bit of economic history for you, but it's important to understand these things. Okay, now let's go to basis risk. Okay, so that there's a statement here that it could be that the hedge transaction is in the same MIC as the UP. Okay, but what is happening is let's just write it. Let's just put only this, otherwise everything is in bold. Sometimes you have a unlike, but then we are going to use the example of jet fuel. Okay, so as you know, I think once again, everyone should understand this. If anybody has a doubt here, you can ask me. Okay, Please understand that, again, ideally we would go around the room and ask questions. What do you think an airline's position is? But here I'm just telling it to you. So it is a little bit more efficient, but it could also be a little boring for you. I've heard some reports that people find the class boring sometimes, but you don't have the luxury of finding it boring because you're finance students, and so it is your duty to learn the things that I'm teaching you. So you better be alert, okay? Because you're the one who lose out. Okay. So what I'm telling you is that the airline's exposure is the underlying position of an airline with respect to jet fuel is short, okay? Because they have to buy jet fuel, and once again, if you go back and use the kind of a rule that we gave you, what happens to jet fuel as oil prices go? What happens to an airline as jet fuel goes up? So you should know the economics of the airlines. Okay, it's not mentioned here. I've not mentioned it here. So jet fuel technical term is ATF, which is aviation turbine fuel. It is chemically, I think, I'm not a chemistry student, but I think it's either exactly equal to kerosene or very, very close to kerosene. Okay, so it is a part that it is something that comes out of the distillation process of crude oil. Example is that airlines exposure as ATF and the oil futures are extremely liquid. Okay, let me explain this why. Okay, little bit. I have not explained it, but this is true of airlines globally. All right, on average. Okay, yeah, maybe not great English here, but you understand what I'm saying. We look at the operating costs of most airlines because the economics of the airline business in terms of the cost side, of the operating cost side, is not very different whether you're in Ireland or India. So you'll find generally it is around 50 operating costs. If you look at the operating expenses, jet fuel is around half of that. So naturally what happens is and what happens with jet fuel is, we have a diagram further down below. Yeah, we'll have to reduce this a little bit, I guess. Let's make it like this. Okay. As you can see, crude oil and jet fuel, they move together because jet fuel is actually refined from crude oil. This is the input in the refinery. Yesterday, remember, we were talking, Shrishti asked that point, made that point about the refinery in the MG refining case. So the refinery has to buy crude oil. So remember, in the case of a refinery as well, that you have to look at a similar situation. A refinery per se does not have, unless the refinery has access to crude oil exploration, etc., E&P operations, exploration and production. A refinery has no net exposure to crude oil, but they're short crude oil because the refinery has to buy crude oil, and they're long the, not necessarily jet fuel, depends on what the refinery makes. All the distillates, we call these distillates, okay, because they're coming out of the distillation process. So we say these are downstream distillate products, and this is the upstream product, the input, the crude oil price. So the refinery, like Reliance actually is very well known internationally. Their refineries are supposed to be technically very, very high quality. The production and the construction of those refineries, they apparently built some of the best refineries in the world at a very, very fast pace. There's something to be proud of as Indians, that an Indian company it's internationally considered to be some of the best refineries and very quickly built. So Reliance Refinery is, if you ignore any kind of E&P assets that Reliance might have, E&P assets means they actually own some oil fields, okay? So I don't think they have, I think they have some KG6 or the gas material, but I don't know if there's much oil there. But let's assume they don't have oil. In that case, they're basically, their net exposure is a short position. So I've jumped quickly from the airline to the refinery, but you should be comfortable with that. So if you're looking at a Reliance refinery and assume they don't have any access to crude oil, so they don't have any E&P assets, is what we would say, then the refinery's position is actually, they don't have an outright position. They have a spread position. The refinery is short crude oil and long distillates. So here we're showing one distillate with jet fuel. It could be gasoline. And there's a very interesting chart on the CME website where they show you all the different distillates. So they have like crude oil and they have like a picture here with different temperatures and what comes out at each temperature as you distill the oil. Okay, so you can check that out. So these are, so we said the refinery is actually long the distillates because it will be selling these distillates, and it is short crude oil because it has to buy the crude oil and then refine it. Okay. In a similar way, if you see what we said, why are we saying that? Why are we saying that? Why did we say? So, market instrument combination. How do they buy jet fuel? They buy it on the spot market. So, airlines exposure, underlying position here, exposure or UP to the, when we discuss underlying positions, always with respect to MIC, jet fuel is the market, ATF, and spot is the instrument. Okay, so we discuss it like this: MIC, market instrument. Yeah, so we are repeating that term once again, okay? Market instrument combination, MIC, to get used to this so that next time we will not, we'll just use the MIC term. Okay, so why am I saying this now that you understand? We're just, again, running you through some concepts, basically rehashing these concepts, okay? We're not, it's not like we're learning anything new. We are rehashing the concepts because we've already done them, right? So, airlines, I want to just make sure that people understand what we mean by this. Airlines exposure to the jet fuel market, market instrument combination, MIC, is short. Why is it short? Because on average, 50% of the operating costs of airlines is jet fuel purchase costs. And generally, you have to assume that these are fairly, almost like perfect competition kind of industries. So they have no real ability to control the output price. They are price takers on the output side. So your kind of ticket prices are more or less fixed. I mean, not fixed, but they don't have any control over it. So as if 50% of jet fuel prices rise and 50% of your operating cost is showing an upward trend, that's obviously not good for you, okay? Because your revenues are assumed not to be changing that much, or at least not by the amount of the increase in the operating costs, not by amount of the increase in, not by the amount of the increase in half of your operating costs. So this is bad news, basically, right? So jet fuel prices going up is bad news for an airline because your costs are going up, and most likely your revenues are not able to compensate because these prices are going to be, as we saw, jet fuel prices are very closely tracking the crude oil prices. I'm not even going to show you the chart anymore because you have seen it, because jet fuel is a distillate from which is coming out of crude oil. It's exactly like if you are talking about yogurt prices. Instead of jet fuel, you put yogurt, and in place of crude oil, you put milk. So it's not possible that milk prices will keep on going through the roof and yogurt prices will not change. It's not possible because the yogurt is made out of milk. So this is the exactly same kind of thinking, okay? So therefore, again, so why do we say that the underlying position is short with respect to this MIC? Because we use that logic once again, that if the jet fuel prices go up, then these guys lose money. If jet fuel prices go down, then their operating margin improves because the costs are going down. Again, we assume that the output prices are sticky, ticket prices are sticky. So therefore here, if jet fuel prices go down, their P&L improves. If jet fuel prices go up, their P&L is adversely affected. And therefore, we say that, and then we remember that the position that behaves in this manner is the short position and not the long position. That is the market going up, you lose money, market going down, you make money. Which position behaves like this, long or short? The answer is short. And that's why the airline's exposure to the jet fuel market is short. I wanted to go through that once again. If you remember, Utsav had given this answer in a complete form several classes ago, fairly early on in the course. So you have to remember, this is how you should approach it. Because why am I teaching you to think like this? Because if you do it like this, then it's logical. You don't just blindly memorize stuff. Okay, it has to be done logically. So you only memorize that little algorithm that, what kind of questions to ask. The only thing you memorize is actually what kind of questions to ask. So, right. So this is basically, so you understand now, you learned a few things, that an airline's UP with respect to this MIC is short. Then you also learned that a refinery, which is not here in the notes, okay? We'll put it here. Not really related to the discussion, but since we are talking about it. Like our very own Reliance Petro, very big refineries. Now, see, Google is so smart. They even know all this, okay? Okay, a refinery like Reliance Petro, assuming they have and you're learning some, this is how we talk in the market, okay? Remember, oil and gas, energy. Energy is a very big sector of the market. So those of you who have dreams of becoming equity analysts, you will be focusing on some kind of sector or the other. All right. So if you focus on a sector like oil and gas or energy, they might call it energy today. If you focus on a sector like that, you have to be familiar with, even otherwise, you should be familiar with these terms. Okay, so if somebody's on the business television, on a business television network is talking about it, guys, what's happening to the E&P space? If there's dramatic movement in the oil price and they want to know what is happening to the E&P space, that means they're talking about the prices of oil companies like Exxon, Chevron, Pemex, Pemex, and all these kinds of companies. These are all companies that own reserves of Shell, okay? These companies, these are all guys who own reserves of crude oil, Saudi Aramco. That's what they're talking about when they talk about E&P. E&P stands for, these are terms that are used in the energy industry, okay? So you should be familiar with all these terms. And these are the E&P companies that I told you about, Saudi Aramco, Exxon, Chevron, Pemex, PDVSA. PDVSA is the Venezuelan oil company. Venezuela, as you know, very badly managed country, but actually Venezuela's crude oil reserves are higher than Saudi Arabia's. But it's a terribly managed country, so they don't do very well. Their production has been declining, and it's a terrible situation in that country now. I think people are killing dogs and eating. There's no food. They're killing dogs and eating them, so it's a terrible situation. But here's a country which has the highest oil reserves in the world. Okay, so these are E&P companies. You learn this point that the exploration and production, that is, they actually have reserves of crude oil. And so refinery like Reliance Petro, assuming they have no E&P assets, okay, has no outright position. These terms have been decided. ATF jet fuel, okay? What else are you learning? Another term you're learning? So remember, part of your knowledge, you're learning about finance, you learn conceptual ideas, you learn concepts, you learn certain types of skills, you learn some contextual knowledge, and this is part of your contextual knowledge, where you have to learn about the industries that exist in the world. Energy is a very, very big sector, okay? How do people talk about the different parts of the energy business, okay? So distillate means all the things that come out, gasoline, kerosene, etc. Gasoline, kerosene, heating oil, etc. All these are distillates. Has no outright position in either crude or any other distillate, okay? This is crude is their input. So we are deviating a little bit. We are teaching you, but we are teaching you about all kinds of. So what does the refinery do? It puts in crude as an input and then refines that crude and produces all kinds of distillates, including jet fuel, okay? Possibly jet fuel. Some refineries may not have it in their product mix, etc. Okay, it has no outright position. It has a refinery. It has a spread position. Please remember these things. Go back and check all these concepts. Okay. Warning to many people who are. I'm not naming names. Basic concepts are not clear. Very often we find when we try to check basic concepts, they're not clear, not because you're stupid, but because these are new ideas which I'm just exposing you to. And if you don't hammer your brain with these ideas several times and put a lot of effort into it, you hammer it into your brain until it becomes automatic. You think about it automatically. It is just a matter of time and effort. That's why it's not clear to you. Not because you're stupid, but because you haven't put in the time and effort to build that foundational knowledge. It has a spread position. So I'm describing the spread position in general terms. Okay, the spread position is long input and short. Oh, sorry. I put it the wrong way. Okay, it's short input okay. Once again, if you want to understand this, how will you do it? Again, apply your logic. This is we can put a third bracket because we are actually saying that this is not really a part of the discussion. I just put in this because I thought it's important for you to understand these things, and it reinforces your understanding of the outright position, etc. What is this? That you have, what do we say? Spread position. It has a spread position. A refinery has a spread position and does not have an outright position in either crude or any of the distillates. Okay. So let's put a board here. Crude. It has a spread position which is short input and long outputs. Input is only one, crude oil, and long outputs. Why is it like this? Think about it. If a refinery, so what are we saying? Refinery has a spread position and it has no outright position in either crude or distillates. We don't really call, I mean, of course, if you look at it only the input side, you could say that they have a position, but that's not how you should look at it because that's not the full picture, right? So why do we say that they have in the spread position, they have, what is the nature of the spread position? Remember, spread position, you have to always mention what are you talking about? What is your spread position? Like here, if you sold April and bought May, then your spread position would be short April or long May. You would say that I have a spread position in crude oil. I sold April and I bought May. You could have also bought April and sold May, but you will describe it, but that's not what you did. So you have to describe your specific position as long April and short May, right? So that's how you describe spread positions, and you describe your position on each leg. But you treat it as a spread position, not as an outright position in either of the legs, because that's the true nature of the spread of your position, of your exposure, right? So if you look at it, what are we saying? A refinery's position is a spread position in the crude or the distillates, and the spread position nature is what? Because you have to talk about spread positions like this. What is the nature of the spread position? Short input and long output. So why am I saying that? Again, same logic. So assume Reliance Petro is buying crude oil and selling jet fuel, okay? So what are they? If crude oil prices go up, crude oil is an input for them, so their costs go up, assuming the other ceteris paribus analysis. So the other things don't change. Crude oil prices go up, so their inputs, these are inputs for the refinery. So input prices go up, that means their P&L will decline. If crude oil prices fall, ceteris paribus, including the output prices, nothing changes. So then their operating margins will improve, okay? On the output side, if gasoline prices, ceteris paribus, crude oil doesn't change, gasoline prices go up. Again, Reliance's operating margin goes up because output prices go up, input price remains the same, right? So always do this kind of analysis. Make sure that your answers everywhere, always learn to think logically. Don't memorize anything because that will not get you very far, all right? So think logically, understand this. This is also something else to understand and to reinforce your idea about the, reinforce your ideas about underlying positions and outright positions and spread positions, okay? So refinery, we have on the, sort of en passant, as they say in French, we have learned another thing while discussing an airline's exposure on the way to discussing basis risk. In passing, we have also learned about a refinery and what is their position, okay? It's a spread position, not an outright position, okay? So ATF is a derivative of crude oil. And so what we are saying here is we are talking about okay, yeah. So now what are we saying here? Basis risk assumed. Okay. So we are talking about now here we have this problem here. What are we talking about? Talking about liquidity. So we're talking about a situation, the underlying position in the market, there's not enough liquidity. Okay. Meaning of not enough liquidity means there's got to be low. Low transaction costs, high price transparency, and possibility of an easy exit. This would characterize, just in case there's any confusion, this would be the characteristic of a liquid market. So if you are your underlying position is in a market which doesn't have enough liquidity, okay, you may decide to hedge in a different MIC. And not in your own, not in the MIC in which the UP exists, because you may want to dynamically manage your hedge, etc. All right. or you may just want to get a better price, because you may not even get a good price. Even if you do a static risk management program, you may not get a good price in the jet fuel market because there's not too many players, but lots of players in crude oil. So what the airline is doing, it's got a short underlying position with respect to jet fuel. And so therefore it needs to have a long hedge position. But the question is, should we put on the hedge position in jet fuel, or should it be put it on in crude oil? And the problem with jet fuel is that the market is not very liquid. Okay, so let's talk about this a little bit here. That's what we're discussing here. So the reality is this, that jet fuel is not very liquid, but in comparison, Brent crude futures, West Texas crude futures, okay, Brent is the North European benchmark, West Texas North American benchmark, very, very liquid markets in futures, but not so much in the spot market for jet fuel. So therefore, airline, what it does is that it looks at this kind of chart. And so the CFO sits down, the risk manager sits down, treasurer sits down and says, okay, let's look at the prices. And we see that, and we discussed this yesterday in the previous class, that look at this thing, and then I think I discussed it in response to Siddharth's question, and where everybody may not have been around. But do an exercise for yourself if you can find the data. We don't have the data, but you don't even need to do it. You can do it. You don't need to find the data. You can just take the approximate numbers visually from the screen, put it in a spreadsheet, and do two things. Okay. Plot. Just take a few prices. Maybe take like 3 prices here, 2 prices here, and 3 plots here. Okay. Just read it off visually from the screen. And do the same for the red line. Okay, so just put it like maybe nine values for each of the series. So to create 2 series in a spreadsheet and 9 data points. Okay, and of course it's very, very small. Can't even apply, not even 30 data points. But this is just to basically see the understand the point. What will happen is, if you take those data points, do a SD for this. Do an SD for the individual red line, the individual black line. Then also plot a new data series, third data series. There are 2 data series we have plotted from here. Plot a third data series, which is jet fuel minus crude oil. Define that as a variable. That is the crude oil jet fuel spread. Put it in column 3. This minus this, okay? And then you plot, that will also give you a series, 9 data points. Then you do the SD. So you look at the SD of this. SD is standard deviation of this, standard deviation of this, and then do the standard deviation of the spread. Okay. What you will find is that the standard deviation of the spread is much lower than the standard deviation of either this or this. Okay. So this is why an airline would want to basically have the treasurer will say, okay, I can't handle this kind of volatility, and the standard deviation is taken as a proxy for risk. Okay, and volatility, as you know, historical volatility is measured as standard deviation using that technique, basically. So the treasurer is going to say, the airline treasurer is going to say, dude, I can't handle this kind of risk, too much volatility. But I can live with the spread volatility, because when I plot it in column 3, it doesn't look like a big deal. All right. I can live with this. So let me do one thing. I'm not going to stay short jet fuel. I am going to hedge jet fuel by buying crude oil futures. Now I've got a spread position. I'm long crude futures. I'm short spot jet fuel. Okay, we'll just finish it off. There you go. Okay. I'll just wrap it up quickly here. Just a minute or so. So what does the treasurer say? This is important to understand. This is where basically, this is what is called, now they are exposed to basis risk. That was what we discussed. Okay, we're going to continue. We wrap it up in the next class. But at least you should understand the beauty of this logic. SD of column 3 is going to be much less than the SD of these solutions. So the treasurer is saying, I can't handle this kind of volatility, but I can live with this. So let's go long. We are short jet fuel underlying position. Let's go long crude oil futures, and then we'll have a spread position. We don't have an underlying position. Spread position risk is much more manageable. That's why, if you remember when we discussed CME, If you go and look at the initial margins on the CME page, you will see that they charge you much lower margins if you do in many of the commodity markets. If you put on a spread position, long April, short May, long December, short March, if you do that kind of contract, the initial margin is much lower than if you did outright position in either of the months. Same principle, okay? Please remember this. This is what we are learning here, okay? And this risk is called the basis risk, okay? Because this stuff is not constant. You see the spread, it's not constant. See how tight it is here? See how wide it is here? It's not constant. So that fact that this is not constant, this is the basis risk, okay? So we'll complete this up in the next class. Okay, I'll see you guys day after. You can leave now. Anybody with a conceptual question can stay back, and then we'll deal with any operational questions. Anybody has a conceptual question?
Yes, sir. Sir, about this, sir, what are the in practical, what are the next best places we can use for hedging? Like for jet fuel, it is crude. The next best, another thing could be a benchmark that is highly correlated to this. Sir, what about other places we can use to hedge?
No, basically, you would always look for when you are faced with a situation like this, when you have what makes you think in this way, when you are in this kind of situation, that you notice you can't help your underlying position. If you decided to start an airline, you are going to have an underlying position in jet fuel. You can't help it. Now, you find that there's not enough liquidity in the jet fuel market. So straight away your problem begins. Now, how do you solve it? Typically, you just look for what is the next best option where you have a trade-off between the liquidity of the hedge and the kind of effectiveness of the hedge, where you find something. So obviously, if you're a depends on who you are. Like for instance, if you are a let's say if you're a European airline like Ryanair, which is very active in crude oil hedging, in jet fuel hedging. Ryanair is an Irish airline, and so they would hedge against Brent crude futures, using Brent crude futures, and they would not use West Texas Intermediate futures because West Texas is a North American benchmark, and these guys are operating in Europe, so the Brent price is much more likely to track their actual jet fuel purchase prices. So the basic thinking here is going to be that you're going to look for something which is a liquid instrument and is very closely tracking. So you would be doing this kind of analysis. To answer your question, the algorithm to that, instead of giving you a precise answer or a specific answer, I will answer you in terms of what kind of algorithm you will run. There's your underlying position, okay? And there is one possible MIC in which you can put on the hedge position, okay? So you collect the data, plot this, and calculate the spread and see the spread volatility. Then, okay, maybe this is West Texas futures, then replace this with Brent Freight futures. Those two are not the same, okay? If you plot Brent versus West Texas, even there you'll see the spread is not the same, okay? So first you do the analysis with West Texas, then you do the analysis with Brent, find out which of the two has a lower spread volatility, okay? And then there is so obviously the basis risk is less if you use the one with the lower spread volatility. But then you have to see, is it a good fit to what kind of, that will be captured in the basis risk itself, okay? So then you look at the relative liquidity of the Brent versus the West Texas, which is actually not a lot of difference, okay? So in this case, you would go with the one with the lower spread volatility. But sometimes you may choose something which has the higher spread volatility, but because it has higher liquidity, and because you may be wanting to run an active risk management program, a dynamic risk management program. So those would be the considerations that you would look at the spread volatility when your choice, because Siddharth's question is with respect to the choice of hedge instrument in cases where you cannot avoid basis risk, okay, because your UP is in a very illiquid market. So that you cannot avoid basis risk. So Siddharth's question is, how do I select the optimal hedge instrument? The answer is, it's a comparison between the spread volatility, you will consider each hedge instrument. You will compute the spread volatility, and you will notice that. But you will also look at the liquidity of the spread instrument. Because if you're running a dynamic hedging program, you will be buying, selling in the hedge MIC, all right? Or in the MIC where the hedge is going to be put on. So therefore, the liquidity of the hedge MIC in which the hedges are going to be put on is also very relevant. So it is quite possible that you may decide that you're going to be running such an active, dramatically dynamic hedging program that you'll be buying, selling several times a day. So therefore, liquidity is more important to you than spread volatility. So you may choose a hedge instrument which has a higher spread volatility relative to your UP. But you still choose it because the liquidity is much, much greater. That is a decision for you. There's nothing wrong with that. It's a subjective, it's a value judgment. Okay, it's like you chose to study management and you didn't choose to study computer science. It's not like nothing wrong or good or bad about that. It's just a value judgment. You prefer to study this subject. Yeah. So does that answer your question, Siddharth?
Yes, sir.
Yeah. Any other conceptual question?
Sir, in a job like I got to see a job where in the JD they wrote that one of the key roles are identifying risk assessment for a person's portfolio. So does that mean that we have to identify the KRFs of that portfolio?
Yeah, so the KRF and all these terms which I've basically created this theory. Okay, they may not use those terms, but that is essentially risk assessment. Yeah, so that is essentially that is what you'll have to do. The stuff that I have taught you on risk management is something that you'll have to do everywhere. But no, see, those kinds of jobs, they seem to be talking about active risk books. They seem to be talking about investment portfolios. So there, the analysis will be a little bit different. What I have taught you in IFM, this is the framework that can be applied always for any kind of passive risk book. So I think the kind of job JD that you're talking about, that maybe sounds a bit like the investment counselor kind of JD, where you do a risk assessment, you go and talk to Vipul Garg, and Vipul Garg has a lot of money and he doesn't know much about the market. He wants to take your advice. He wants to know how to invest his money. So then you look at Vipul Garg's, what is his age and what kind of business, how many family members does he have to support, and therefore what kind of investment is appropriate for him. It sounds to me like your JD was talking about that kind of job, which is different. So my framework, which I've given you, is it will apply always in a corporate treasury risk management case, which is basically a passive risk book. Okay, so you may need to watch that JD once again. I think it's an investment counselor JD. Sounds like an active risk book. That's a slightly different kind of analysis. But the concept of KRF will still apply. Because if you look at, say, Sachin's book or Vipul's book at any point of time, he's holding positions in short Maruti, long Airtel. So in that case, when you look at his book, the KRFs will be spot prices of Maruti and spot price of Maruti and Airtel shares, because those are the markets in which he has positions. So that KRF analysis will still apply in the active risk management portfolio, active risk book situation as well. You can still use that term because it helps you to focus on where the risk is. Yeah, is that clear?
Yes, sir. Yes, sir.
Now we go to Vipul. He had raised his hand.
Sir, I have an administrative question.
Okay, all right. So I'll close the recording. So I presume nobody has.
Sir,
Yes.
Yes, sir.
Yes.
Sir, I want to ask that the prices which are given in the chart we are just seeing, these are the spot prices.
Yeah, these are spot prices. Okay, these are in this particular chart, right?
Yes, sir.
Yeah. So Platts is a source of news actually. There's a Platts Petroleum. These are basically Platts gives energy market prices. So these are spot prices. Okay. So these.
Yes, sir. Okay, sir.
Yeah. Yeah. Okay. All right. Anything else? So we'll go to our conceptual questions over for today. Is that correct? So we'll go to, before we go to Vipul's question, I will stop the recording.